Hey traders, as you navigate the risky world of trading, one of the things that you have to keep in mind or keep in check is risk management. Learning to manage your risk effectively is going to mean the difference between you being a profitable trader and you being a losing trader. In this video, I am going to show you everything that you need to know, something that you can use in your trading to make your trading a profitable journey. Risk management can help you even when you have a losing streak to emerge a profitable trader after a given period of time or after a certain sample size of trades. If you want to learn and make your risk management better, watch this video from the beginning to the end and you will really be amazed at how this is going to open your mind and help you with your risk management. Some of you also asked me how to use the risk to reward tool. I'm going to show you how to do that in this video, but please don't skip the video. Watch the video from the beginning to the end so that you don't miss the important nuggets that I'm going to be giving you in this video. And also be sure to give the video a like, subscribe to the channel if you've not yet subscribed, and let's get started. I'm going to explain to you guys from the beginning to the end how you can manage your risk using risk to reward ratios, and also how much percentage you are going to risk per trade to see yourself becoming more profitable. Okay, so I am going to first begin by explaining to you guys who asked me last time what is the risk to reward ratio tool you are always using. This tool you guys are seeing here, it's called a risk to reward ratio tool. Before I go any further, I need to explain to you guys what that tool is. Now that tool is on TradingView and it is free of charge. You get that tool when you go to this left panel here where the tools are, the drawing tools are, and then you click where you're going to see projection of forecasting tools here, and then you choose the long position is for buy setups, and then the short position is for selling or short markets. Okay, when you reach here, make sure you click the star to the right so that you make it a favorite. When you make it a favorite, you will be able to put it on this tool you see on top of the screen right here for you to get access to these drawing tools much faster. Okay, you can also, after you've done this, added all this long and short position onto your favorites box, make sure you click the bottom. You see the star at the bottom, this blue star right here. If I click it, you see it turns on these shortcuts on and off like this. Okay, make sure that star is clicked, okay, so that you can be able to see your tools up here. Now these are called the long and short positions. So the risk to reward ratio tool is a tool that we use to measure how much we are risking for what reward, for what amount of reward. Okay, so for example, if the market is going up like this, creating higher highs and higher lows, okay, and we want to take a trade, for example, at this breakout here, you have this setup and you want to measure how much you are risking for what reward. You use the long position if you're going to buy, and you use the short position if you're going to sell. For example, if the market is creating lower lows and lower highs like this, okay, and then there is a break and retest, and you want to measure the risk to reward that you are going to get in on a trade. For example, here there is a breakout here, and you want to measure how much you are risking for what reward, for a 1 to 2 risk to reward ratio. Now this is what you do. For a long position, you come here and choose long position. You see that tool is named long position. You see, long position. Or on the left panel, if you click here and go to projection, you choose the long position, this one, okay? And then you drop it where you're going to enter the trade from. You can just drop it there like this. It will appear like this. Normally, it is not this color. This color, I have just set it. To set the colors, you see the panel that appears on top, this one, you can change the color to whatever color you want. Some people have it in green and whatever, okay? Like for example, if I put it at default, okay, let me say restore defaults. This is the default color, okay, for the long tool. And the short tool also, we can put it at its default color, okay. We just apply default so that you can see the colors. So these are the colors that you will see like this, okay? So if you're entering a buy, the red color below or the red box below is your stop loss amount or the percentage you are risking, okay? This is how you measure it. You see the figures that are changing at the bottom here. I don't know if you guys can see clear. Let me just zoom in and hopefully you guys will be able to see this. You see in this box, in the middle, there are some figures you're seeing here. There is a figure that is saying risk to reward, risk stroke reward ratio. And the next number is 1.28, which means you are risking, for example, 1 to get 1.28, okay? You're risking 1 to get 1.28 times, okay? So if you increase the reward, you will see that that figure will change. So normally I tell you to use a 1 to 2. A 1 to 2 will change this to 2, flat 2, okay? For example, if we increase the reward, the green part is the reward, okay? So when you increase this, you will see that figure will also be changing. This figure here that says risk to reward will be changing. Right now it is at 1.87. So if you increase this till it reaches 2, you see there now we are at a 1 to 2. This means that we are risking one portion to get twice as much. So in trading, I always encourage you to use at least a 1 to 2 risk to reward ratio, which means you are risking one part of or one portion to get twice as much. For example, you are risking $10 to get $20. This tool helps you to measure where you're going to enter from and where your profit is going to be, where you're going to put your stop loss and where you're going to put your take profit, okay? So if you double click on this tool, this window will pop up. This window is going to show you your risk, okay? It can help you to calculate your risk. If you put here, for example, you're risking 5% and then your account size, for example, is $1,000 and you're risking 5%, okay? It will tell you what lot size you're going to use when you're entering your trades here. It will also show you what price you're going to put your take profit at and what price you're going to put your stop loss at and how many pips you're going to be risking to get how many pips. For example, here if we want it to be exactly a 1 to 2, we can put this at, for example, 400, but that's already calculated because we've used the risk 5% here, okay? But if we change this to, for example, 400, we are risking 40 pips, which are in ticks here, 400, and then here we put 800. You're going to see that it will still be a 1 to 2 risk reward here, but now the prices will change for the stop loss and take profit. So that is how you use this tool right here. It's the same thing with the selling market. It's just switched. The stop loss is on top and the take profit is at the bottom. All right, so you can see here now, this is a risk management and risk to reward ratios explanation. Now, let's start from the left here, all right? A 1-to-1 risk to reward ratio, as I've showed you on the other tool. This is the same tool here I've shown you here, okay? Now, here you can see that the blue box, this blue box here on top, is the same as the gray box, which is for the stop loss. So that's a 1-to-1 risk to reward ratio, okay? And then this one is, the blue part is twice as much as the gray, which means this is a 1 to 2. And then this one, the blue part is 3 times the gray part, which means this is a 1 to 3 risk to reward ratio, okay? So with a 1-to-1 risk to reward ratio, with a sample size of 10 trades, let's assume we take 10 trades straight. For example, that is 2 weeks. Each trading day, each trading week has 5 days, okay? So this is 2 weeks of trading. Those are 10 trades for the Forex market, not the crypto market, okay? Let's assume we are risking the same risk. For example, we are risking 10% of the account, okay? We are risking 10% of the account. For example, we have $100 and we are using a 1-to-1 risk to reward. With a 1 risk to a 1 reward ratio, with a 50% win rate, meaning you win 5 trades and you lose 5 trades, okay? In this case, we expect to break even at the end of the trading period. Okay? If you're using a 1-to-1 risk to reward ratio, some of you have a good strategy or have a profitable strategy, but you're not using the correct risk to reward ratios. Now, I want you to see how the risk to reward ratios impact your profitability. Okay? So if you're using a 1-to-1 risk to reward ratio, what happens is that if you take a sample size of 10 trades, okay, and you win 5 and lose 5, it means at the end of the trading period, you are going to come out break even or even with some loss on your account, because you're going to be paying fees like commissions, swap fees, and the spread. That is going to take away some money from your account. When you're using a 1-to-1 risk to reward ratio, you will end up losing even if you are getting 50% win rate. This is why you should avoid using a 1-to-1 risk to reward ratio in your trades. However much you have a good strategy with a good win rate, you must avoid using a 1-to-1 risk to reward ratio. This 1-to-1 risk to reward ratio can only work if your strategy has a very, very high win rate, like 70% win rate. There, you will come out profitable. But tell me, guys, anybody who has a 70, 80, 90% win rate consistently for a full year, even all the strategies I've shown you here on the channel, most of them achieve a 70%, 80% win rate. But that win rate is not consistent. It is not consistent. There are sometimes when the strategy goes through a losing streak and you end up having a win rate of like 40%, 50%, even 30% sometimes. The win rate of a strategy is not consistent. That is why you will never have a trader who can trade the same way and winning exactly the same way year in and year out. You'll find that even the most professional traders get into some losing streaks. So you have to mind the risk to reward ratios you are using. Now let's look at the second example here. When you have a risk to reward ratio of 1-to-2, which means you are risking one part of your risk to get twice as much, okay? For example, with the same strategy you used in the previous example here, you have a 50% win rate, okay? For 10 trades, you win 5 and you lose 5. We expect to be profitable by half the total risk, meaning if the total risk for 10 trades, for the whole 10 trades, you are risking $100. Meaning if you're risking $10 per trade, for example, that is a total of $100 risked, okay? You are risking $100 total risk to expect a profit of $200 because your reward is twice your risk, okay? But out of those 10 trades, you win 5 and you lose 5. It means you are going to lose $50 because 5 times 10 is $50, okay? You're going to lose $50 out of the total risk that you invested in, which is $100, okay? And then you are going to get a reward of $50 times 2, which is going to be the number of trades that you have won, which are 5, times the reward, which is twice, because this is a 1-to-2 risk to reward, which means your reward, whatever win you get, you multiply it twice because you're using a 1-to-2 risk to reward ratio. Okay, the number of pips you're risking, for example, if you're risking 10 pips, you are getting a take profit of 20 pips. If you're risking 30 pips or a stop loss of 30 pips, you are getting a take profit of 60 pips. That's what this means, okay? That's how you're setting your risk to reward, which means the $50 which you got from the 5 wins, okay? The risk of $50, you multiply it twice, you get $100. Now your total reward will be $100 minus the $50 that you lost. You will remain with a profit of $50 with the same strategy that you used in the previous example. I think you can see already how a 1 to 2 risk to reward ratio can change your trading from being a losing trader here to becoming a profitable trader here with the same trades, same risk percentage, and same examples or same strategy. Okay, so in this strategy, still with this same strategy, with a 1 to 2 risk to reward ratio, you don't need to win 50% of the trades for it to be profitable. You just need a 40% win rate. If you get a 40% win rate, you will still be profitable, meaning you lose 6 trades and you win only 4 trades. But the 4 trades you've won, multiply them by 2, which means $40 times 2 will be $80 minus the $60 that you've lost. You will still have a profit of $20 just with a strategy that has a 40% win rate. You can see how risk to reward ratios can make you profitable, can help you with your edge in trading. Okay, so let's move on to a 1 to 3 risk to reward ratio so that you can see how this helps you with your trading. So with a 1 to 3 risk to reward ratio, with the same 50% win rate, sample size of 10 trades, you win 5, you lose 5. Okay, so you are risking $100 still, but you are now expecting a profit of $300 because 10 trades, you're multiplying them times 10, which is 100, but you are expecting 3 times that risk, which is $300, right? However, you don't win all the $300. What happens is that you win 5 trades, you lose 5 trades, meaning you're losing the same amount of money, the $50 that you lost in the first example and in the second example. The risk is the same, $50, but the reward is what is changing. Okay, so out of the $50 you've lost, you get a reward of 3 times that risk, which is $50 times 3, which is $150. Now you get this $150. Okay, you subtract the $50 that you have lost. What do you remain with? You remain with $100, no matter whether your strategy has had a 50% win rate. Okay, you will always make money if your reward is 3 times more. Okay, now here with this 1 to 3 risk to reward ratio, you don't even need to win 40% of the trades. You only need to win 30% of the trades to be profitable with this strategy. Guys, tell me how much simpler you want trading to be. Just tell me how much more simpler you want trading to be. Why do we overcomplicate trading, really? Why do we overcomplicate trading? You can easily use the 1 candlestick strategy or any other strategy I've shown you here on the channel and just focus on your risk to reward ratios. Okay, you can lose many times, but the moment you win or the moment you have a large enough sample size, for example, if you trade the 1 candlestick strategy for a full month using this what I'm showing you here, you will always come out profitable. I'm telling you guys, you will come out profitable. All right, so with a 1 to 3 risk to reward ratio, you only need to win 30% of your trades for it to be profitable. Okay, meaning out of 10 trades, you only need to win 3 of them and then you lose 7 of them for it to be profitable. Meaning your loss will be $70, okay, $70, but your win will be $90. Your win will be $90. So 90 minus 70, you will still have $20 profit with a 30% win rate. Just guys, look at how this is changing your mind right now as far as your risk management is concerned. Now, what about the lot sizing, you may ask? Now, don't ever worry about lot sizing, okay? Never worry about lot sizing. The only thing you need to worry about is how much percentage risk you are taking for your account, okay? For example, here I'm on babypips.com/tool/position size calculator. This is all you need for you to know what lot size you are going to use per trade, okay? What you do here is just input your currency in which your account is, okay? For example, here we can put $1,000, right? Let's use $1,000 as an example, right? Now, determine how much you are going to risk for any trade you're going to take. For example, here, you're going to risk 5%, right? 5%. For example, here, you have a 1 to 2 risk to reward ratio, okay? Just click on that like this, and then you see your stop level. You see stop level, and you see the word ticks. Ticks are 10 times more than the pips. So this is just divide this by 10, you'll get the pips for the stop loss. So that is 28.9 pips. Okay, we can just round it off to 30. Let's say 30 pips. Okay, to get 30 pips will be 300. To get like 600, that's a 1 to 2 risk to reward ratio, as you can see here. Okay, so our stop loss pips are 30. You just come back here to the portion size calculator, and then you input 30. Okay, just put in 30. Those are your stop loss pips, and then you choose the pair. For example, here euro dollar. Okay, you click on calculate. It will show you how many lots you're going to be risking on that trade. So you want to consider the one that says standard lots here. Okay, standard lot. So you're going to risk 0.16 lots on that trade, or the amount at risk will be $50, which is exactly 5% of $1,000. So guys, I don't want to make the video too long. If you found value with this video, guys, give a like on this video. Bring this video to at least 500 likes, guys. Let us make this video reach many traders who are also struggling with risk management. I know this risk management will help you to become a more profitable trader. Guys, this information that I'm giving you here is rarely given out for free on YouTube. I just need your support by you liking this video, sharing it, and also joining some of the links that are in the description of this video. Go join the free Telegram, and also contact me if you want to join the VIP signals, okay? It just costs $35 a month. And also, if you purchase the Audacity Capital Pro Farm Challenge, or if you signed up and you've not yet purchased the challenge account, use the discount code that is in the description of this video to get yourself 10% off of your challenge accounts with Audacity Capital. Guys, let's go and trade. Let us win together. Thank you for watching. Until next time, guys, peace and out.